The Securities and Exchange Commission was established by Section 4 of the Securities Exchange Act of 1934, codified at 15 U.S.C. Section 78D. Created on June 6, 1934, under President Franklin D. Roosevelt, the SEC was a New Deal response to the 1929 market crash and the inadequacy of state-level blue sky laws. Its foundational mission is threefold: to protect investors, maintain fair and efficient markets, and facilitate capital formation for the American economy. Moving into the structural mechanics, the SEC's independence is a core regulatory feature. The SEC is governed by 5 commissioners appointed by the President with Senate consent under 15 U.S.C. Section 78D. To ensure independence, no more than 3 commissioners may belong to the same political party, and they serve staggered 5-year terms. Operationally, the SEC functions through 5 divisions. The Division of Corporation Finance reviews all registration statements under the Securities Act and periodic reports like Form 10-K and 10-Q. This ensures transparency and material disclosure for all public market participants. The Division of Investment Management oversees mutual funds and registered investment advisors with at least $100 million in assets under management. These numeric triggers and structural barriers protect the integrity of market disclosures and institutional oversight. Public disclosure is centralized through the Electronic Data Gathering, Analysis, and Retrieval System, known as EDGAR. Every registration statement, proxy statement, and insider transaction report must be filed electronically to ensure immediate public access. Beyond digital filings, the SEC maintains a physical presence through its Washington, D.C. headquarters and 11 regional offices. The Division of Trading and Markets oversees the essential infrastructure, including national securities exchanges and clearing agencies. They administer the registration of broker-dealers under Exchange Act Section 15, ensuring the mechanics of every trade operate with transparency. From the consolidated tape to the NBBO, the SEC mandates transparent, dual-channel disclosure delivery across all market venues. Supervision is executed through the National Examination Program, identifying compliance deficiencies before they harm investors. The SEC maintains jurisdictional control over self-regulatory organizations, or SROs, including FINRA under Exchange Act Section 15A, and the MSRB under Section 15B. SRO rule changes must be filed under Section 19B for formal commission approval. Furthermore, the Sarbanes-Oxley Act of 2002 established the PCAOB to oversee auditors and ensure corporate accountability. The Dodd-Frank Act of 2010 expanded authority over derivatives and created the Whistleblower Program for successful enforcement tips. This program provides awards of 10 to 30% of sanctions collected for information leading to successful enforcement actions. The Division of Enforcement investigates violations, bringing civil actions for injunctions, disgorgement, and substantial monetary penalties. It also utilizes fair funds under Sarbanes-Oxley Section 308 to return penalty and disgorgement proceeds to injured investors. For exams like the SIE and Series 7, remember the SEC is the primary federal authority enforcing the 1933 and 1934 Acts. Understanding the SEC's bipartisan structure and its oversight of SROs is foundational for every regulatory expert. Mastering these statutory mechanics ensures you are prepared for the most rigorous sections of your securities licensing examinations.